Welcome to the next edition of Pizz-Spectives. Today I have the pleasure of introducing Adam Vocale from Jellis Craig, Sorrento, and John Morello from Jellis Craig in Essendon. These guys are experts in their field and in their geographies. So thank you very much for giving up your time today, guys.
Pleasure. Great to be here.
Yes,
Now,
thanks for being us, Rob.
No worries. So before we start and get into the detail of outlook for property and the like, Adam, I'll start with you. Tell us a little bit about yourself and also about your business down there at Sorrento.
Yeah, so our business, Rob, focuses more on the southern point of the peninsula. So we've got two offices based in Sorrento and Rye. Rye was probably a more recent addition to the offices down here on the southern peninsula. But essentially, our focus is to sell homes or holiday homes or investments to prospective clients anywhere realistically from Safety Beach down to Porty. So we specialise more across that Porty, Sorrento, Blairgowrie, Rye market, but at the same time, we're happy to look after clients that have properties ordering up toward Rosebud, Dramata and Macrae Safety Beach.
And you, John?
So we're in an inner city market. So we're our geography basically starts from the CBD, the fringe. So West Melbourne, North Melbourne, Parkville, sort of Carlton, all the way through that, we call it that inner northwest corridor of Melbourne, right through that sort of what we call that city of Moonee Valley predominantly, right up to your East Keilor, Avondale Heights and every suburb, sort of Moonee Ponds, Essendon, Strathmore, Askerdale back into the city. So our sort of demographic of client is typically investors looking to get into an apartment in, say, in a true inner city, Kensington, Flemington, North Melbourne, who then become first home buyers. And then we've got what we call the upgraded market looking to get into that, say, more established Moonee Ponds, Essendon, Strathmore, family home. And then it's that life cycle of then the downsizer from those bigger homes looking to downsize back into inner city. Funny enough, that's pretty much our sort of broad market. We always tend to say it tends to be more of that, I call it the mums and dads market that we deal with. That's our specialty. And obviously a lot of predominantly owner occupiers, but the investment market has always played a big role in that inner city market.
Yep. And you've seen a few cycles, John?
I have, Rob. Yes, it's been 27 years real estate this year. Started at the age of 20. So you can do the math there. But yeah, no, it's been a great journey. The industry's obviously been certainly very kind to us, but it's certainly, we've seen the highs and lows like with any markets.
Yeah. Next time we chat, I should ask you, how many prime ministers have you seen in your time as a real estate agent? How many elections?
How many elections best? That's right.
There you go. Now, let's reflect on 2024. Now, obviously, it was a difficult market for Victorian and Melbourne properties. I see nationally today's prop trade data came out that nationally house prices grew 5.5%, but Melbourne actually fell 1.6 across the board there. So, Adam, what were some of the takeaways, learnings and trends and headwinds you experienced over 2024?
Yeah, look, in terms of headwind, I think 2024 was a bit of a flow on from arguably end of 22, 23 and into 24 with interest rates doing what they did and rising. We had such unprecedented growth down here in such a short period of time. So there was a lot of people that purchased down here and arguably stretched themselves a little bit beyond their means based on the advice of the RBA with interest rates not necessarily doing anything until 2024. All of a sudden we see 11 or 12 or whatever it was interest rate rises and people were in a position where they just couldn't hold on. And then at the beginning of 2024, there was an increase in land tax, and then there was the vacant tax, and then the COVID land tax as well. I think that then saw a headwind in regards to an oversupply of properties coming on the market. At any given time, usually around Porty, there might be around 15 properties on the market. We saw that blow out to about 30, 35. Sorrento, there was in excess of 60, same as Blairgowrie. And then in the postcode of 3941, there was over 200 properties for sale. So all of a sudden it becomes a bit of a race to the bottom. And that's where some vendors were arguably a little bit pressed to get out of their property more than others. And so there was a bit of a disparity around pricing across the market. It was actually quite hard to tell or pick the value of some properties because you could look at one and just go, geez, I can't believe that only got that. Or you look at another and go, I can't believe that actually achieved that based on comparable sales. So we actually lost a little bit of touch of what is comparable. And I think we've navigated okay through that into 2024 and toward the end of 24 and into 25 because land tax is arguably simmered a little bit. And land tax affects a lot of different people. And one of the main factors that we saw, there was a lot of generational homes that have been held in families for so many years from the 70s, 80s, 90s. And obviously they've appreciated over time. And so a land tax bill has come in this day and age. And all of a sudden you might have siblings where they've got an estate in Portsea, and all of a sudden they've got a land tax bill of $60,000, $70,000, $80,000. And they're looking at each other going, none of us actually use the house this summer, or you use it a little bit more. So why would we actually split this evenly? And with a bit of family debate, they go, well, let's take it to market. They obviously take it to market, but then we're having to try and find that buyer that is willing to actually pay that, and then also go through that process of the land tax saga that is. So it's fair to say there's been quite a few headwinds. At the start of the year, there was not many people coming through open for inspections. We do 8 or 9. Personally, I'll do every day, and sometimes I'll meet 2 people for the whole day. And you just think, I was actually better off just not turning up and hoping that somebody would call me and say, where are you? Fair to say, I think those moments are a little bit behind us, and we're actually starting to see a bit more improvement coming in towards the end of the year and start of 25.
Great. And then John, any trends that you saw or reflection on 2024?
2024 probably was a year of consolidation for a lot of vendors in the market. Pricing, as the data has told us, hasn't really done much in terms of from a growth perspective. Probably just very much working with more the motivation or the needs of vendors around whether it's upsizing, downsizing, whether it was cost pressures, whether it was land tax, not so much land tax pressures, probably more investors selling out of stock, that with all the interest rate rises, all the compliance costs, probably an element of that is also land tax. So a combination of all those factors. So landlord getting out of property and then selling it into a lot of the owner occupiers pretty much now, whether it be first home buyers, second home buyers. And then I suppose dealing with the pricing side of things, I think, as Adam said, it was a very challenging year around what something was worth versus what we believed it was worth based on recent sales or comparable sales. It nearly got to the point that mid part of the year where we had to say anything that happened 6 months ago was irrelevant. We've really just got to look at what's happened in the last 60 days, what is currently on the market in the next 30 days, knowing what's in front of us and making I suppose an assessment on price based on that. And hope most times we did get it right. There were times there that we thought we priced it right. And until you go to market, you don't really know where, but it was a very, I think, fickle, bit of an inconsistent market. There was properties that really surprised us, and then there was others that really struggled. And it also came down to when was it purchased? If they were the 4 key years that I talk about often with owners, 17, 18, 21, 22, and you had to resell today or this year, you were either selling for what you paid or anywhere between a 5 to 10% discount on what you paid, less any costs or any other sort of improvement values that you put, any other improvement money that you might have put into it. So it was a challenging year. But at the same time, we did achieve some great results for our vendors and help lots of purchasers get into the property. And as we kept those conversations going through the process, really coming back to why are you buying now? What's the real underlying motivation or need? And just focusing on that and really, I suppose, adjusting people's expectations is probably a good word to say, okay, don't look at this property as a purchase for 1 year. Look at it as a 5 to 10 year plan and really understanding what's the why for them.
Yeah, exactly. That's the thing about property. It's a long-term investment and it's quite illiquid. And when you're a forced seller, it's very difficult to get out of illiquid assets. So if we look forward to 2025, and just to give you a bit of a context as what the expectations are for the economy in 2025 is economic growth of around 1 to 2%. And that's predominantly driven by an uplift in private demand, which comes from income rising, wages going up, but then cost of living pressures coming down and rate cuts supporting some of that, what disposable income coming through. So we'll see the private demand come up, which is obviously in 2024 was all about public demand, government spending that supported the economy. We're expecting 3 rate cuts. Whether we get one in February, we don't know yet. It could be used for a bit of insurance by the RBA, but the expectation is one by at least May, which is around about when the election is. And we can talk about that a bit later. And then maybe 2 more then. So in total, about 3 rate cuts over 2025. But in saying that, probably if you go back 12 months ago from today, the expectations are for rate cuts in 2024 as well. So let's cross our fingers and hope for the best. And then globally, US should be the leader of economic growth out of the world. Obviously, they're implementing tariffs. That'll probably start the moment that Trump goes into office, late Jan. and that'll start with Canada and Mexico. But because of tax cuts coming through, the consumer will be in a strong position. So the economy should still see strong growth there. So if you put that there, I'll ask you again. I'll start with Adam again. Let's talk about 2025 as 2024 came to an end or come to an end. Tell us about 2025.
I think as you touched on, Rob, there's a lot of, I tend to believe that a lot of people are very much driven by the media, and there's a narrative around the market in 2024, which was, it was all doom and gloom. And now we can start to see that there's a bit of light at the end of the tunnel, and there's banks that are addressing that and saying that things are arguably going to get a little bit more comfortable in 2025, and not necessarily full reprieve where it's, let's go out and buy a beach house. But at the same time, I think people are going to let the dust settle on their finances, and that might play a role in their decision-making for 2025. Now, what that means for our market, certainly not any increases in property prices, but what it does mean is it might broaden the buyer pool. So instead of dealing with one buyer on a property, we might actually be dealing with two or more. Does that inevitably then increase the price? Potentially. But it also means that there's probably going to be a little bit more urgency around buyers to act quicker. Days on market, if you recall, and John will agree, that in 21, it was so crazy that we'd open something on a Saturday, and by Monday, you'd have a phone call from a vendor saying, why hasn't it sold yet? And pre-COVID down here, average days on market was anywhere between 60 to arguably 90 days. And now we're seeing that again back in the market. So we're finding that normality and finding our feet. But at the same time, 2025 may just see a little bit more urgency and a few more results coming to fruition quicker than anticipated. In terms of the market of buyers and who's looking, I think it's very much going to be the same. There's still going to be that discretionary buyer that's looking for a beach house, purely lifestyle. There's also going to be what we call a transitional buyer. They're the ones that John is arguably selling their inner city apartments or town residents to. They just want to have their foothold in the CBD or thereabouts and be close to family and friends and the footy and friends and whatever it may be. And they'll buy something a little bit bigger down on the peninsula that is where they'll spend most of their time. And then they'll just go backwards and forth between the two, because the PPR down on the peninsula is a lot more affordable from a land tax point of view, considering it to be an apartment or a town residence in town. So they're probably the main sort of things that I think we'll see into 2025.
Okay. And then, John, how are you seeing your market?
Probably similar to this year. I feel like there might be a bit more buyer confidence and vendor confidence, for that matter, to come to market. There was a bit of hesitation this year, particularly from, I call it the empty nest, the downsizer market, Rob, that I say there's a real shortage of, in our market, the opportunities for downsizers. There's an element of our vendors that have sold and in Melbourne because they've got their second coastal or regional property that they've made that as a principal place of residence. And therefore, as Adam said, still want a foothold in the inner city market as a Melbourne base for 2, 3, 4 days a week, maybe, to still enjoy all obviously the cultural experiences that Melbourne has to offer and sporting and the like. So we see the same as what's probably happened this year. A lot of it will be dependent on the stock coming into the market. We're hoping to see a bit more volume. We felt like the volume ticked up a little bit towards the second half of this year. We've listed well for the first sort of quarter. Next year, our average days on market, unlike Adam's, is probably sitting at around 22 to 24 days. So we tend to move our property pretty well and fairly.
Is that shorter than normal, John? What's it normal?
Look, on average, most of our stock that we sell, probably 75 to 80% is by auction. So it's a 4-week, pretty intense campaign where we're working a property 2, 3, 4 times a week. Speed to market is a really big thing this year, getting the result that we've had. Often the buyers, again, are coming back to, I call it the buyer's motivation, understanding how long they've been looking for. The conversation we often have with vendors is, it's not how long your home's been on the market, it's how long the buyer's been in the market. How many times have they gone back for a reapproval? Obviously, as we understand, most of the buyers we tend to deal with do have some sort of finance approval in place. Yes, there's an element of the cashed up market that doesn't need bank finance, but most buyers that we tend to deal with do have some sort of finance approval in place and may last 3 months. If they've had to go back multiple times, I suppose they've seen or experienced the effect of how the banks have assessed them. And they're at the, I call it, if they've been in the market for 6, 9, 12 months, they're at the point now where they've seen the whole, where it started to where it ended. And the way I've been really encouraging buyers in the last maybe 3 months is saying, the market's at pretty stable point at the moment. It's not necessarily going to shoot up fast. It's probably not going to drop any further. We certainly hope not. I think any price fallout's already happened, and it's all going to just be, I think, supply related. And then with the confidence of hopefully some interest rate cuts and some better economic news, that might encourage people to start transacting more. But I don't necessarily see it having this massive uptick from a price growth perspective anytime soon.
Yeah. If you're talking about an asset moving from 0 to -5% over a 12-month period for liquidity and long-term investment, then it shouldn't matter. If you find that own that you like, you should just be purchasing it for that long term. In my view, not advice.
Yes.
It's just a general comment around the liquidity of property and how difficult it can be to find the place that you like. So don't try and get too cute sometimes. Now, just finally, I know we're talking about some 2025 trends. Let's talk about some longer term trends. Exactly what I was saying just then, around 0 to 5%. So Adam, I'll go back to you to start that point. Where you are, there's a supply shortage, really. You can't recreate land where you are. What are some of the trends that you expect to see over the next 10 or 20 years?
I definitely feel as though infrastructure improves in terms of the connection from here to Melbourne. I definitely see it as though down here, in comparison to the rest of the inner city suburbs of Melbourne, it's so affordable. And there's a lot of hospitality and amenity being, I suppose, driven into this community. And I think that there's going to be a little bit more of an outlook of what does it actually look like to live here permanently. I know that for some young families, if they were to spend the same amount of money on a home down on the peninsula versus the inner suburbs of Melbourne, it's vastly different what they'd be able to live in terms of a comfortability point of view, land size, close to the beach, close to amenity. But obviously, you're not close to the CBD. Now, obviously, that correlates with everybody's working conditions, and some people are still working from home. Others are still needing to go into the CBD. And so people are weighing up that lifestyle choice. What does it actually look like for us to work in the CBD 2 days a week, but also live on the peninsula for the remainder of that and have our children brought up in that sort of environment? There's some really good schools down here. There's some great grammar schools all the way up to Mount Eliza, and there's buses that take them there. So a lot of that, I suppose, the hurdles of why people wouldn't move down here are slowly overcome. And so therefore, I definitely feel as though the longer term trend would be that there is going to be a bit more of an influx of permanent residents and more families, as opposed to the empty nesters that are coming down here at the moment, transitioning into a sea change. So it's something that I definitely feel that, look, I drink my own bathwater. I'm passionate about living here and I love living here. And I wish I moved down here 10 years ago instead of 5. But at the same time, in comparison to Melbourne, I love Melbourne. That's where I grew up. I've got a special spot for Melbourne in my heart, but at the same time, life's better by the beach. And so I definitely feel as though from an affordability point of view and what you can actually live in down here versus Melbourne, that's going to start to really come to light for a lot of people.
Okay. And John, any longer term trends from your area?
I think there's, particularly this inner northwestern corridor of Melbourne, it still represents exceptional value in the market. We've seen it definitely happen this year where buyers that maybe didn't have, whether it be Essendon, Moonee Ponds, Strathmore, Nitre, Kensington, not so much Kensington, Flemington, it's always probably been a bit of an inner city hotspot, but it's very much, we're finding buyers are coming into the area that may have started looking in, for example, Northcote or Fitzroy, or they're selling out of an inner city suburb and they're getting a lot of value for money, particularly the upgrading market. Our sort of typical family double front home in Essendon, Moonee Ponds would sell between that 2 to 3 million. If you pick that house up and put that in, say, like a Northcote at the moment, or a Thornbury or a Alphington or an Ivanhoe, you're paying probably 3 to 4 million for the same sort of similar architecture, probably on smaller lands. The area still represents exceptional value where, anywhere between 0 and 8 k's to the CBD. We are on the airport side of Melbourne. So we're literally halfway between the airport and the Melbourne CBD. We're definitely seeing a bit of an influx of even some interstate investors, seeing Melbourne and the inner northwest as an opportunity. So there's some good buying opportunities at the moment for investors that are either coming from your Sydney, your Perths, and even for Adelaide. It's interesting. We're seeing buyers coming out of Adelaide into Melbourne, even though we've seen people transitioning from Melbourne into Adelaide. And obviously the Adelaide market's performed exceptionally well the last 2-3 years because of coming back to probably what Adam said from an affordability perspective. I think Melbourne still is an international city. Yeah, hopefully we've gone through majority of the hardships during the COVID years. There's a lot of rebuilding that's gone on from a business perspective from obviously a public investment perspective. And I think it's going to transition now into sort of some more confidence from a private developer perspective over the next, talking to some developer clients that, not that we do a lot in that space, but I like to keep my finger on the pulse. There seems to be a lot in the pipeline for the future over the next sort of 1, 3, 5, 10 years. And I think that's only going to be a great thing for Melbourne, and population growth will certainly underpin that. Yeah, look, I think although at the moment it might seem a bit bleak, so to speak, but I feel in the next 3, 5, 7, 10-year plan for Melbourne, in particular inner city, where all the infrastructure, as we know, all the metro tunnels and all that's being invested in, we're probably a lot behind the curve. We've probably now invested too much into that side of things, and there hasn't been enough private, but hopefully the private investment over the next 1 to 5 to 7 years will balance it all out.
Yeah. And so some of the trends that I'm seeing from a financial advisor's perspective is two front. One is the wealth transfer. So over the next 20 to 30 years, there'll be $3 billion of wealth transferred from the baby boomer generation to the next. So what they do with that money is either they pay off a mortgage, buy property, buy that lifestyle asset. So that's down the beach. So that's one trend. To your point around population growth, that's very strong. And the other one that we've seen for the first time in almost 15 years since the GFC is that the cost of construction is actually higher than the replacement cost, which means it's actually cheaper to buy an existing property now than it is to construct. So these are two trends that long-term, the wealth transfer, but the second one only happens once every 20 odd years. And this is where it's happening now. So you can see that there's a bit of a flaw in the market. And to your point, John, earlier, we can see the market flatten from here. And that's probably not a bad time to step in if you're looking at potentially buying for the longer term. This is not advice, just general comments. And anyone that's act on that advice does so entirely at their own risk. So just to finish off, guys, just to give yourselves a bit of a pitch, Adam, what's your competitive advantage and why would a vendor want to be using your practice to sell their property?
I think down here, and obviously having the two offices, once upon a time, buyers were very specific about where they look. So a Rye buyer would want to specifically look in Rye. Sorrento buyer wouldn't consider Blairgowrie or Rye. They'd probably look more towards Portsea. But now we're finding that there's probably that cross segment of the market where buyers are very open to looking at different areas. Now we control a good part of the market from Rye down to Portsea. So in terms of buyer and cross referencing of buyers, we've definitely got that covered. Not to get into the nitty gritty of Jellis Craig in general, but John will agree we've got a database of over 1.5 million buyers. 1.5 million contacts. And not to say that we've got 1.5 million buyers for a specific home. It'd be great if we did. At the end of the day, we've just got more access to people and understanding their trends and what they want and their motivation. And that's the biggest part of it all, as John touched on earlier. Buyer motivation, why you're looking to buy, and seller motivation, why you're looking to sell. And we're just there to try and bridge that gap. So in terms of us, we've got more access to properties, more access to buyers, and it works both ways for the buyer and the seller.
Fantastic. And John?
I think that to sort of build on that, I think one of the uniqueness of Jellis Craig is we have got 40 offices across inner Melbourne, regional and coastal. It's a pretty unique sort of geography and footprint that we cover. We've got an open database, a shared database. So it's again quite unique compared to other multi-office networks where it's what they call silo databases. We've got an open database. So there's a huge amount of what I call intel. We talk about the ecosystem of Jellis Craig. We've got some phenomenal data these days. We've got a facility or a platform, I should say, called Jellis Craig Live that we give all our vendors access to, where it pulls all the analytics together from REA, Domain, the Jellis Craig website, and it gives complete transparency to our vendors to see what is actually the inner workings of what we do on a day-to-day basis in real live time. And what it does is it also identifies how many buyers are already within the Jellis Craig ecosystem versus new buyers that are coming to market or coming into the network for the first time. So I think our interconnectedness across the whole group is a big selling point. And there's a lot of crossover, particularly in that inner north where we've got that wedge, that inner northwest corridor. Then we've got the inner north offices of sort of Northcote and Fitzroy and Brunswick. So there's a real connectedness between the offices in this particular sort of geography. And we do have lots of crossover with Adam from time to time. I've got business going on down at the Bellarine Peninsula at the moment in Port Lonsdale. And that's the beauty about the network, that we can pretty much get the whole of Melbourne and pretty much Victoria these days covered. When a client comes to us at Jellis Craig, we can service them from end to end. They're not just a vendor, they become a purchaser, they become a landlord, a property owner. And it's just that full life cycle of a client that we get to take care of. And that's probably that gives us the most enjoyment, that you're becoming their trusted advisor when it comes to real estate, as they have a trusted advisor when it comes to all the financial other investments like Europe.
Fantastic. Thanks for the plug, John. Appreciate it. Adam and John, thank you so much for your time. All the best for 2025, and hopefully we can do this again in another 12 months.
Yeah, look forward to it. Thanks for your time, Rob. Thanks,
Guys.
Adam. Cheers.